Dividend growth investing without the dividend growth. Links are in the description of this video. My goal as a long-term investor is to constantly grow the income flow from my portfolio. There is more than one way to do that. You can invest in assets that individually grow their own dividend year after year, organic year-over-year growth, and hope the market notices and moves the market price up accordingly. Or you can invest in higher-yielding assets that may never grow their own individual dividend and create your own portfolio income growth through reinvestment and compounding. The first is called dividend growth investing and is what most professional investment managers and writers have been recommending for generations. The second I call income factory investing. It lets me sleep better at night and actually view downturns as opportunities for accelerating income growth. How much extra return are you getting if you reinvest dividends? Some of the dynamics of how this happens are interesting. You can see that during the flat price periods for the investment, during which periods the stock was repeatedly referred to as dead money, the dividend reinvestor actually gained a long-term advantage. That is because the reinvested dividends bought more shares than would have been the case if the stock's price had been moving steadily upwards. Those extra shares ended up making a disproportionate contribution to the investment's total return as time moved on. Warren Buffett has pointed out this non-intuitive advantage of stagnant prices many times. Here is how he put it in Berkshire Hathaway's 2011 letter to shareholders. The logic is simple. If you are going to be a net buyer of stocks in the future, you are hurt when stocks rise. You benefit when stocks swoon. Emotions, however, too often complicate the matter. Most people, including those who will be net buyers in the future, take comfort in seeing stock prices advance. Charlie Munger, and I don't expect to win many of you over to our way of thinking. We've observed enough human behavior to know the futility of that, but we do want you to be aware of our personal calculus. And here a confession is in order. In my early days I, too, rejoiced when the market rose. Then I read Chapter 8 of Ben Graham's The Intelligent Investor, the chapter dealing with how investors should view fluctuations in stock prices. Immediately the scales fell from my eyes and low prices became my friend. Picking up that book was one of the luckiest moments in my life.